So we have some big news from a company called HP Enterprise. Their stock is skyrocketing lately, and they actually have some big news on a deal with X.com, formerly known as Twitter, related to AI. So right now their stock is actually up 3.37% today on the 15th of January 2025. In the last 5 days, they are actually up 4.95%. In the past month, up 6.64%. And in the past year, they're actually beating the S&P 500 at up 52.19%. Now, if you're wondering what HPE does, it's a global IT company that provides products, services, and solutions to help businesses manage their data and applications, which of course involves things like storage and protection of data, software, computing, networking solutions, cloud services, a lot of things that are, big right now and probably built to last for the future. Now, as far as the news that they just had here, HP Enterprise beat out some other major companies like Dell and Supermicro for a $1 billion deal with X. So they tell you right here they won a deal with more than $1 billion to provide the social network X, again, also known as Twitter, with servers optimized for artificial intelligence work, which was reported formerly by Bloomberg. They also mentioned that two major publicly traded companies were beat out in a competition for this deal. So they were basically gauging interest in this deal, trying to find the best company to partner with, and HPE beat out Dell, whose stock has been great in the past year, and SMCI. So this is for something I've been really keeping an eye on for the future, which is AI data centers. We've been talking about AI data centers, how they're impacting the energy grid and how it's impacted the Constellation Energy stock in past videos. But it's also good to look at what companies are actually going to be building these AI data centers and basically partnering with other companies that are prioritizing AI going into the future, because you can't have AI without these huge data centers. And they also mentioned how liquid-cooled technology remains in high demand. So some other things I like about this company, obviously the price, not too bad, $23.30. Part of the reason they have such a good price is because they have a higher dividend yield than a lot of companies do at 2.23%. They also have a really good PE ratio. A lot of other investors, if you watch their content, a lot of them talk about getting under 20 or 25 as a PE ratio, and theirs is actually 12.08, which is actually very low. So not only do you have some really solid growth over the past year, and also some really solid growth over the past 5 days, and today alone at up 3.37%, but you have a really good PE ratio, a good price at $23.30, a dividend yield of 2.23%. Now, one thing to consider, over the past 5 years, they're averaging just over 10%, almost 11% per year in growth, which could be better. It's going to look better after this dip gets kind of phased out for the last 5-year graph. So if they keep the growth they have, their past 5 years will look really good here going into like 2026. But if you're looking at just growth alone, you could probably do better in some other areas. Obviously, none of this is financial advice, but just the way I'm processing this. Instead of going at it like, oh, this is for growth, this would be great for like a dividend portfolio if you're really prioritizing dividends. And not only are you getting a solid dividend yield with a company that just had some really good news going forward with a huge deal with X.com, beating out major publicly traded companies for that deal, but also you're getting the growth. So you're getting growth and dividends, which can be a very hard combination to find. They still also have a majority buy rating from analysts on Robinhood's analyst score. They have 20 analysts rating it at a 55% buy right now, which I like to look at, obviously not as an end-all be-all, but just as something to kind of check my own analysis to get maybe a second opinion. We also had some information on SimplyWall.Street, which is a website that does a lot of analysis of stocks. They say there may be an opportunity with Hewlett-Packard Enterprise companies 25% undervaluation. So they mentioned right here, again, this is a major like stock and analysis company. So obviously not an end all be all type of thing, but something to also consider if you're looking at just a few other perspectives before making a decision, which is something I like to do as well. And using the two-stage free cash flow to equity, their fair value estimate is at $29 $22.47, and the current share price has been around $23. Obviously, this was written before their price jumped up. So analyst price targets are around $24, and then they say that's 18% below what they think is a fair value estimate. So if you like the analysis of this site of, again, Simply Wall Street, you could also factor that into whether or not you think you might want to buy this or not. Another reason this company has actually been on my watch list for a while, but even before this news, they are a company, again, that deals with major industries that I believe are still the future and as well as the present. But they also are a well-managed company according to their employees. I think it's very important to look at what employees think about working at a company to get an idea of whether or not they may actually be able to last, and not just about what their products and services are or what their ideas are, but are they well managed? So they actually have a 4.1 out of 5-star rating for their employees, which really like working here. They actually got nominated for Best Places to Work at number 51 in 2023. 83% of people who have actually worked at HPE have recommended working here to a friend. That's an extremely high score. And 90% of their employees that left a review here gave them an approval rating for the CEO. So all of these scores right here, the overall rating, how many recommend working here to a friend, and the approval rating of the CEO are all very good scores from their employees. They also have a very large sample size of feedback with over 20,000 reviews. Overall, I think HPE is an interesting stock that I'm considering buying, or at least considering getting some this year, because I'm not necessarily looking at them as a long-term high growth, but they're kind of in between, like a safe dividend investment versus something that's high growth. You can get a little bit of growth over time. Again, they're averaging a little over 10% a year with some strong news and growth starting the year, but also you have a low PE ratio on top of the fact that we have some stock analysis companies saying that they are undervalued as well. So we have multiple indicators that they are undervalued. Again, the major news with the X.com deal, which is going to capitalize on a major trend going forward in the importance of AI data centers, along with the fact that people actually have very good scores for what it's like to work and be a part of this company as an employee, as well as really good CEO scores. So it seems like they're in good hands. Again, none of this is financial advice, just some things to consider when looking for individual stocks to buy, especially if you're interested in earning some dividends. But with this information, I definitely will keep HP Enterprise on my watch list, consider buying some this year, especially for my dividend and more conservative portfolio.